Good afternoon, everyone. I'm Dave Weisberger, the CEO of CoinRoutes. It is Friday, March 24th, and it's time for This Week in Crypto. Well, we've had an interesting week, although if you look at the actual box scores, it doesn't look like a whole lot's happened. Going back a week, Bitcoin is up between 4 and 5%, depending on which particular minute you're looking at. As predicted last week, we tagged into the 28,000 plus range. We've fallen a little below that right now. The reality is it's kind of been chopping around, even on the Fed day. So we'll talk about what the Fed did and said, but the range that was carved out on that day, both in the upside and the downside, has become the range, a very tight range actually, for the rest of the week. Not a lot of action. Ether's been a little bit underperforming Bitcoin over the last week. NASDAQ has been underperforming a little bit more. The delinking of Bitcoin from the stock market seems to be proceeding. But the truth is everything at this point is focused on the macro side. And the macro side is what we're going to talk about mostly before we talk about the news. So let's talk about the Federal Reserve. What did they do? Well, as predicted by yours truly, it did exactly what I expected. They raised rates 0.25%. They gave themselves wiggle room to be able to point to something, i.e., tightening bank credit, as a reason for pausing rate rises. But barring that, they're still targeting more higher rates at the end of the year than the market was picking. And so as a result, the market's sort of sold off, but there's other things going on. So what is happening? We're having in the middle of a banking crisis. Now, we talked about last week how Elizabeth Warren decided to attack Silvergate Bank and kind of triggered the idea in people's heads that maybe my banks aren't safe. And having done that, caused a stampede to the exits at Silicon Valley Bank and the need for the Federal Reserve to do something over the weekend. And we talked about what that was. That was the BTFP, the bond program, where you could take a bond that you bought for $100 that's now trading at $60 and borrow $100 against it at whatever the Fed's prevailing interest rate is. It is a way for banks to be able to meet depositor outflows without having to sacrifice. So what the Fed effectively did is, people are talking about this as quantitative easing or whatever. At the end of the day, they made $4 trillion available on the hopes that it won't get used. And so they don't have to print 4 trillion. They do have to print hundreds of billions, but they don't have to print all of it. They wanted to make and reassure the markets. And so we've had various people out speaking about, from the Fed and from the administration, oh, the banking system is resilient. Oh, it's safe. Let's be clear here. Here's the data. We know that on bond portfolios of U.S. Treasury bonds alone, the banking system of the United States probably has a $600 billion hole. That is a loss to those of us not in banks. If you had to sell, they would lose that much. But that doesn't even count what their losses are on agency security, on MBS securities, on corporate securities, on munis, etc., on interest rate swaps. We don't know what that total loss is. Best estimates are it's almost certainly much larger than just on treasuries. It is probably larger than the entire market cap of all of crypto that has been lost by the US banking system. So when one digests that, you come to a very simple conclusion. The conclusion is, OMG, the Fed is going to need to print to deal with it. But at the same time, the Fed is worried about inflationary expectations. I will give it to Powell. He got it right. In his statement, he specifically focused on inflationary expectations because he knows that if he didn't raise rates this last time, two things would have happened. Number one, people would have been panicking. They were saying, oh my God, the Fed sees more than we do. Because remember, people don't really get a good look at bank balance sheets. The regulators don't have the best look either, but the Fed probably has the best look of all. So if he did nothing, then that was going to admit panic. And that was a really bad idea. So he didn't want to do that. The second thing is, he can't afford to be seen as pulling back on fighting inflation. Remember, the Biden administration has made it crystal clear that they don't care about doing anything to solve inflation except to say the Federal Reserve is on the case. They have literally put it all on him, which a lot of economists would say can't work. You can't have fiscal deficits in the multiple trillions of dollars and expect the Federal Reserve to quell inflationary expectations completely, because after all, with more money, you do the math, it's supply and demand. Money supply goes up, money value goes down. The value going down is exactly inflation, et cetera, et cetera. But be that as it may, he's trying to thread a needle. And so he did what he had to do. What's interesting about what he did say is he also said correctly that if the banking crisis gets worse, that is sort of a synthetic tightening because it means credit conditions won't be good. People won't be able to borrow money to spend, et cetera. And that will potentially contract the economy. Powell, in conclusion, also said that he believes it will take some time of below trend growth, that's euphemism for recession, in order to squash the inflationary expectations in the economy. And so the question really becomes, can he engineer that to be just below trend growth or a so-called soft landing or not? It feels to me like that will be impossible because at the end of the day, the banking system has massive losses. At the end of the day, the banking system has been paying way below what they should in terms of interest rates because of the losses, of course, but they're paying on savings accounts much, much less than you can get in money market funds or even by buying treasuries directly. That means that deposit outflows are likely to continue. That means the Fed is going to get tapped. That means more monetary printing is going to happen, and the liquidity is going to have to be pushed into the system. And that's why Bitcoin is holding up quite so well, despite its moniker as a risk asset over the past year, 2 years, et cetera. I've said this in multiple places. The reality is Bitcoin trades like an option on its future adoption. And anything that undermines confidence in the banking system, anything that undermines confidence in the fiat system writ large is going to ultimately be good for Bitcoin in terms of its potential adoption. And that is not really being priced in by the market particularly, but the trend is still higher rather than lower. In the short term, it could bounce around, but I'm talking the next sustained move, I believe, will be to the upside. Sure, we might see a downside move. And this is not financial advice. Please do your own research, make your own expectations. I always invest for the long term. I would not use leverage, and I am not encouraging a short term trade here. But let's talk about the news because honestly, there is a lot of stories out this week, but arguably the biggest ones, in addition to the Federal Reserve, are the things coming out of the SEC. And there were two things I want to point out, one more absurd than the other. The first is the Wells notice to Coinbase. Now, I was on the Twitter spaces listening to Brian Armstrong and his legal team. And basically, the SEC, I think, is up creek sans paddle with this one. When they approved Coinbase's S1, they effectively saw exactly how they evaluated what they could list on their platform. Coinbase has been in constant communication telling people and telling the regulators, this is how we decide something is not a security. And they have asked the regulator to say, what do you think is a security? And gotten no answers. So now, retroactively, the SEC wants to go back and say, well, we were wrong. Everything you're doing is a security. We want you to shut down. And Coinbase is like, no. We're going to fight this, and it will go up to the Supreme Court if need be. And the reality is, I don't think the SEC has much of a hope. I think that at a bare minimum, this SEC won't be in power. Certainly, it'll be into the next presidential administration before everything gets sorted out in the courts. And at the same time, Coinbase is moving more things offshore. At the same time, Circle has said they're going to open their office in Paris. And that's a big deal. But we'll get to that in a heartbeat. The second piece of the story was the SEC putting out a sophomoric, almost a college parody style warning to investors about the risks of cryptocurrencies. You could have written what they wrote about in that piece, about any tech stock, about anything. But the reality is they're trying to couch it in terms of monetary history. And there they got it wrong. There's just factual inaccuracies in what they said. The notion that the fiat system, which is only 50 some odd years old and has been showing all this form of stress and fracture, the fact that the inflation in terms of devaluation of the dollar during the fiat system has been way over 95%, all of that is ignored by their warning. Essentially, the SEC is trying to pick winners and losers. It's almost they wrote a poor research report saying why crypto is risky. Unlike the Federal Reserve and FDIC, which talked about the volatility of assets, which is fairly reasonable, as we've talked about before, the SEC telling people, well, we don't think crypto is reasonable, even though it has been the best performing asset class. And that's the funny part, over pretty much any multi-year period that one could look at. And that's despite 2022. It's almost comical. The problem is it's part of a larger action. This administration is very clearly targeting crypto because it doesn't like it. Now, why doesn't it like it? Well, that's easy. And I've said this before, but I want to explain it again. Bitcoin is seen as an alternative to at least measure the debasement of fiat and potentially a longer term replacement. They don't want it to be measured. They want to control the value of fiat, be able to control everything from the CPI, which they've just done yet another sort of adjustments on, to every financial reporting. Bitcoin exists outside that system. They can't control it. They don't like it. The rest of crypto, all of what's going on in DeFi and level layer ones and layer twos in order to create better financial plumbing, they hate even more. Why? Because our financial system is massively over mediated. The banks make economic rent, extra profits on the back of their customers, and don't allow competition across an entire realm of things. And we're seeing it in terms of low bank savings deposit rates. But if you look at the securities lending market, the repo market, the interest rate swaps market. There have been accusations of cartel-like behaviors and class action suits on all of them. They view crypto, namely DeFi, as the enemy, the thing that's going to break their monopoly or oligopoly once and for all. So of course they're going to try to stop it. That's not terribly surprising. So we've seen sophomoric things from the SEC in terms of research that isn't worth the paper it's printed on. We've seen Elizabeth Warren attacking Silvergate, which amusingly is still operational, didn't cause anyone to lose any money, but the banks that got blowback from what she did, so, Silicon Valley Bank, well, that's a totally different story. And even Signature, which was shut down, arguably in error or certainly in malice against the crypto industry, the losses there are because they shut it down, not because they allowed it to continue using the same policies of the Federal Reserve that everybody else could. And we talked about that last week. The fact is, you have this huge dichotomy because at the core of everything that's happened in crypto that we've chronicled for the last year on this program is the fact that crypto lost people a lot of money. I mean, somewhere between 10 and $15 billion last year got lost in situations where risks that were being taken by crypto companies were not disclosed to their users. And that's horrible. And there's lots of reasons to hate crypto for that ish. Except for the fact that the traditional banking system, which is the most regulated financial system in the entire world, a bank, and I used to work for Citi, is regulated by the OCC, the Federal Reserve, the FDIC, also the SEC, also the CFTC, etc. Lots of C's, all of them regulated. Those banks collectively, as I said, probably have over $1 trillion of undisclosed losses. So when you compare 15 billion in crypto to over $1 trillion in the banking system, and you come to the conclusion, well, crypto needs more regulation, the banking system doesn't, that's the wrong conclusion. The right conclusion is our rules should be tending to focus on transparency, on better risk disclosures and other things that I've talked about over the last year or so. But it needs to be in all things. And to make the argument that our current regulation is good and workable and prevents all these problems, it's actually comical at this point that anyone can say that with a straight face. But there you are. We'll see. Next week will probably be yet more follies and yet more of these things. But let's cut it off for now. Have a great weekend out there, everybody.